If you've ever looked at a stock price and thought, why is it constantly changing? You probably assume Wall Street big shots in fancy suits just set the price behind closed doors, right? Well, that's not really how it works. That's why in this beginner's guide, I'm diving into what really drives stock prices. First, we'll answer the how. What is the actual mechanical reason you see that stock price changing every single second? A numerical battle between buyers and sellers that makes the price flicker up and down all day long. Then, we'll answer the why. What decides if a stock is worth $5, $50, or $500? Why does it suddenly surge or crash? Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Alright, let's get to the heart of the stock market. At its core, it's just a massive, chaotic marketplace. Buyers on one side, sellers on the other, haggling over prices in real time. Now, here's something most beginners miss, and it's honestly the coolest part. The order book. Think of it like the market's secret playbook. It's a live, constantly updating list showing what people are willing to pay to buy a stock. Those are the bids, and what others are willing to sell it for. Those are the asks. This thing is like the pulse of the market. Imagine it on your screen. On the left, you've got a stack of green numbers, buyers shouting, "Yo, I'll pay this much." On the right, red numbers, sellers saying, "I'm not letting go for less than this." And in the middle, that's where the magic happens. That's the current price, where a buyer and seller actually agree to make a deal. And by the way, when you check a stock's price on a market screener or app, that number you see? It's usually just the price of the last transaction. But here's the kicker. It's not necessarily the price you'd get if you tried to buy or sell right now. The real price depends on those bids and asks we're talking about, the ones battling it out in the order book. So how does this whole game work? When buyers are hyped, like they need that stock, they get aggressive. They start throwing out higher bids, basically begging sellers to hand over their shares. It's like a bidding war at an auction. And guess what? That frenzy pushes the stock price up. Now, let's look at the other side. When sellers get scared, maybe there's bad news or the stock price is falling fast, they really want to sell their shares. They lower their prices to find someone to buy. It's like a big sale where everyone keeps offering a cheaper price to sell quickly. This makes the stock price drop fast. I hope you now see why stock prices go up and down. That's the mechanical side. Who decides what a stock is worth? To answer that, we need to talk about something called intrinsic value, which is like the foundation of a stock's price. Intrinsic value is basically the real value of a company based on its fundamentals, like its earnings, assets, and growth potential. It's what the company should be worth if you ignore all the hype or panic in the market. But it's not a magic number everyone agrees on. Let's break it down, step by step. First, why does intrinsic value matter? It helps investors decide if a stock is a good deal. If the stock's market price is lower than its intrinsic value, it might be undervalued. If it's higher, it could be overvalued, and you might want to wait or sell. But here's an important disclaimer. Intrinsic value is just an estimate. It's subjective, meaning different people can come up with different numbers for the same company. It's not like weighing a bag of apples where everyone gets the same result. It's more like guessing how much those apples will sell for next year. There are a few main ways to calculate intrinsic value, and each one looks at the company from a different angle. No single method is perfect, so smart investors often use a mix or pick one that fits the type of company. Here are the most common ones. Discounted cash flow. This is like predicting the future money a company will make and then figuring out what that's worth today. You estimate how much cash, profit after expenses, the company will generate over the next few years. Then discount it back to today's dollars because money in the future is worth less due to things like inflation. Here's how it works. Imagine a company generates $100 a year for 3 years, and using a 10% discount rate, those future cash flows are worth about 91, 83, and 75 today. Then we add a terminal value. The terminal value is basically estimating what a company will be worth after your detailed forecast. Say $1,000, which, when discounted, is about $751. Add it all up, and the company is worth around $1,000 today. If the company has 100 shares, that's $10 per share. So, if the stock trades at 8, it could be undervalued, and if it trades at 12, it could be overvalued. That was a simple explanation of how it works, leaving all the complicated financial jargon behind. Dividend discount model. This focuses on dividends, the money a company pays out to shareholders. If a company regularly shares its profits as dividends, you can estimate future dividends and discount them back to today. Think of a utility company like one that provides electricity. They often pay reliable dividends. If it pays $2 per share now and you expect that to grow by 5% a year, you can calculate what the stock should be worth based on that income stream. Asset-based valuation. Here, you just add up what the company owns, like buildings, equipment, or cash, and subtract what it owes, debts. This works well for companies with lots of physical stuff, like a real estate firm or a bank. For instance, if a company has $500 million in assets and $200 million in debt, its intrinsic value might be around $300 million, divided by the number of shares to get per share value. Earnings multiples, like P/E ratio. This is quicker. You take the company's earnings, profit per share, and multiply it by a number based on similar companies. If tech companies usually trade at 20 times earnings, and your company earns $5 per share, its intrinsic value might be $100 per share. But this relies on comparisons, so it's not always accurate. Some investors swear by intrinsic value and base their whole strategy on it. These are called value investors, like Warren Buffett. He buys stocks when they're trading below their intrinsic value and holds them long-term, ignoring short-term ups and downs. Buffett once said investing is like buying a farm. You look at its soil and crops, not what the neighbor paid yesterday. But not everyone thinks this way. A lot of stocks trade above what they're really worth, especially when the market gets excited. Take Tesla, for example. For years, if you looked just at the numbers, how much money it was making, the stock price seemed way too high. But people weren't just buying Tesla for today's profits, but for the future expected growth and new technology. Why does this happen? First, market sentiment plays a huge role. When investors are excited about a company or industry, they bid up prices, ignoring fundamentals like earnings. Second, future expectations matter. Growth stocks, like tech or biotech, often have high prices because investors bet on big profits years from now, not today's numbers. And finally, external factors like low interest rates, like from 2020 to 2022. What made stocks more attractive than bonds, driving prices up? Even for some companies, it's tough to calculate their intrinsic value. Think of startups or biotech firms with no profits yet. Their intrinsic value might be close to zero based on current earnings, but their stock price could be high because investors believe in a future breakthrough. So, is intrinsic value useful? It depends. For value investors, it can really be. They use it to find undervalued stocks, like buying a stock with a discount. It's great for stable companies like Coca-Cola or Walmart, where earnings and assets are clear. But for growth investors isn't always the focus. And for companies with no profits, intrinsic value can feel useless since it's so hard to pin down. Plus, intrinsic value is just an estimate. It relies on guesses about the future, like growth rates or economic conditions, which can be wrong. The market can also ignore intrinsic value for years, staying irrational longer than you might expect. So, while it's a useful tool, it's not perfect and doesn't always work.